Nvidia is down around 5% today. However, at its lowest point, it was down around 7 to 8%. When we take a look at the S&P 500 heat map, we are seeing a lot of rotation out of the bigger, stronger names, Broadcom, Nvidia, Microsoft, Apple, into other companies and industries that have been underperforming over the last few months. Now, this is interesting because just today we did have the CPI report, which was very positive news, where we actually saw inflation down 0.1% from the prior month. And on top of that, we actually saw it at its lowest level in more than 3 years. So maybe you would have been expecting companies like Nvidia, the tech companies, semiconductors, to increase this run even further. However, there are some things just to note. For example, historically, when we do look at what happens when rate cuts take place, real estate investment trusts are actually the industry that does outperform other equity markets, so something just to bear in mind. Now, a lot has happened over the last week with Nvidia. We actually saw a downgrade just last Friday. When we do take a look, in actual fact, it was movement from a buy rating to a neutral with a price target of $135. The reason for this was, as we can see, they believe that the base case for Nvidia is already priced in to the current market value. Well, that was interesting because just a few days ago, we actually got Nvidia upgrade from KeyBank Capital Markets. They, in fact, introduced a new price target for this chip giant, where they say this should be worth around $180 per share, which is very bullish when you do take a look at this company. As we mentioned, down around 5%, but year to date alone, it is already up around 160%. Now, given this information, there is no surprise that when we do look at it on a valuation basis, they do get an F, which is very poor. In fact, the worst score that could be obtained, mainly due to the fact that under whatever valuation method you do look at right now, it is trading at a very significant premium to the sector median, as we can see. For example, on a P non-GAAP basis of just under 50, others in the sector are trading at around 24.31. Having said that, Wall Street still believe this is a very strong buy, and when we take a look as to why we believe it does or is worth, in fact, a premium to others in the sector, just go across their growth. They are looking very strong. A few things to point out. Next year, or over the full year, they're anticipating 82% growth. Sector median, just under 7%. Earnings per share as well, 33.2%. Sector median a lot lower. So there is some case here to be argued at why Nvidia does deserve to be traded at a premium. And a few other points to note. Their profitability, again, a very strong grade of around an A+. In fact, gross profit margin so much better than the sector, 75 versus 49. Bottom line, again, the same to be said here, 53.4%, a lot better than the sector median of 3.16. And you just have to go and look at over the last year, their cash from operations, nearly 41 billion, doesn't even come close. So look, you could say that actual fact this company does deserve the premium. The question here is, how much of a premium is Nvidia truly worth? On top of that, when we do look at this company against how it has performed against others in the industry, now very big names here, TSM, Broadcom, AMD, you could argue it was due for a pullback at a certain point. Just over the last year, it is up 204%, which is very strong when you consider the next best semiconductor, Broadcom, is up around 96%. In fact, over the last 3 years, we see it up 526%. So whether or not you do believe this is sustainable, we can see that just today the market is rotating out of these big names that have been on a very strong run. Nvidia and Broadcom are just a few that we are highlighting today. In other news, they are reporting their earnings as well. The market will be highly anticipating that. It is estimated right now as it is unconfirmed, but the expectation is around the 21st of August, so that is just over a month away. Now, in terms of the expectation from the market, what we are looking at is a 135% year-on-year increase to the earnings per share. Now, some of you may say that isn't sustainable. It isn't something that they will be able to achieve. Well, just look over the last 4 quarters. Their track record is very strong. They have a 100%, in fact, 4 out of 4, so the last year, in fact, and we can see moving forwards again, double-digit anticipated on the earnings per share. Now, if you think the forward P is very costly, well, look at January 2026. If they hit that earnings per share estimate of 3.66, we can see the forward P will come down to around 36.84. Again, comes down to whether or not you do have faith in management and their estimations. So what exactly is the market going to be looking for? Well, a few things that we want to point out. First one, the incredible growth that we saw in FY23 to FY24. Market is going to expect that continue. Just year to date, 26 billion in FY25. That is just 1 quarter of earnings. So if we extrapolate that to 4, that essentially means the market is anticipating around 100 billion of revenues. So they will be expecting that growth to continue. On top of that, the market will be looking towards their margins. As we can see, their operating margin has gone from 34% to 69%. In fact, just over the more recent quarter, we see an increase of 61 to 69%. So there'll be something for the market to consider. How well are their margins moving? Are they at least staying the same, if not increasing? And that's not just on the operating margin. They will also look towards the gross margin as well. Can they see that movement? As we said, 63% in FY20. Now, this is the gross margin to 74, 79 in that more recent quarter. So can they at least see that high number sustained? Or in fact, even better, can we see that gross margin increase? Now, one of the other things that the market will look towards is how strongly is that data center revenue increasing. The CAGR, so the compounded annual growth rate over the last few years, has been 75%. Again, if we extrapolate FY25, around 90 billion for the full year, which is pretty much double the previous year. So is that something we will be able to derive from the numbers that we see? Will the market have faith that they will be able to continue this very large increase that we can see from the data revenue over the last few years? The market will also want to see growth across the board, not just the revenue growth where we saw triple digits, but as we said, the gross margin, the operating income, as well as that earnings per share, which just over the last year is up 288%. Now, finally, some new news that we want to point out just from today. Now, before we've spoken about this, Nvidia are talking about a new industrial revolution. We've covered the new chips that they are bringing out, the Blackwell Ultra, as well as Rubin and Rubin Ultra that they're forecasting over the next few years. But they talk a lot about the Omniverse robotics, how this is going to be one of their largest income streams over the next few years. Now, you could say this isn't directly relevant, but we can see just from today that Tesla are delaying their robo-taxis. So it does beg the question, is a lot of this discussion about robotics something that's a little bit premature? Are we going to see this over the next few years? Or like the robo-taxi, which does keep seeming to be delayed, is that again something that will happen across the AI industry and therefore really hurt the numbers across the board? Now, before we look at the valuation of this company, a few things that we just want to highlight that we quite like and hope that they can continue to increase. Free cash flow per share, as we can see over the last few years, we've seen some tremendous growth. Over the next 12 months, we're anticipating more than double that of FY24. When we take a look at the ROIC, as always, we want a minimum of 12% for the semiconductor industry. Just give us faith that management are able to effectively allocate their capital. Looking very strong, 61 in 24, 78 over the last 12 months. So that is a very strong metric and is incredibly attractive to investors who are considering or looking to add to their position. Another thing that we like, as we've already mentioned, not only are their margins above the minimums we want to see, but it is increasing across the board. We call that operating efficiency, and the same is to be said about the free cash flows. Can they continue with the increases year on year that we have seen? Again, 50% over the trailing 12 month is a very strong signal. Now, finally, with the metrics, we just want to point out they have an incredible balance sheet. Net debt to EBITDA being 0 across the board tells us that it won't even take them one day to pay off all of their debt net of cash on hand over the last 10 years and over the next 12 months. So incredible balance sheet as well. Now, in some other news, as I'm sure you will be aware, insider ownership, while it sits around 4.2%, there has been a lot of insider selling over the last 12 months, around $580 million worth. Few things to point out. Now, we can see pretty much quarter on quarter, this is something that does take place fairly regularly. You'd have to go all the way back to Q3 2022 where there was no insider movement. But when we take a look at who these insiders are that keep selling their shares, we actually note in the more recent period anyway, the CEO has been selling many tranches of his shares, around 120,000 at a time. In fact, just in July, we see him sell around 4 different times, and this has netted him quite a large amount. But a few things to note. Firstly, isn't a massive portion of his total shares, And secondly, look, they need to sell, whether it's personal or financial reasons. It isn't necessarily what we would call a bearish indicator. We then move on to the institutions. As we can see here, around 65% ownership, around 9 billion worth of sales over the last 12 months. But not only do we see a significant amount more of buying during the same period, but we in fact also see in Q2, so the more recent quarter, a lot more buying with very minimal selling, $77,000 worth versus nearly $5 billion worth of buys. So institutions are still very bullish, even at these prices, where we have seen Nvidia take a massive run, even just year to date, and even following the drop that we have seen today. As always, do your own due diligence, though, never copy insiders or institutions. And before we jump into the valuation, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, it is all completely free. You can read straight away, instant access. And in actual fact, in today's newsletter, the more recent one, we did also release a free spreadsheet with 18 undervalued stocks, as well as the prices that we expect them to achieve. Now, jumping into the valuation of Nvidia, we have an intrinsic value at just under $140. The way we got this was using the DCF model, where we have the free cash flow year on year. We can see the average growth around 94%. Now on this channel, we typically have 3 different rates, a low, medium and high. As we can see, we have gone for the medium rate of 30%, and this does give us an intrinsic value. In fact, we can see it here, $140. So we use the discount rate to get the present value of future free cash flows and terminal value. We add it with the cash, subtract total debt, get to the equity value, and divide it by the shares outstanding. So it really depends on where you see this company moving over the next few years. And as we've highlighted before, Bloomberg do see this market industry growing around 42% year on year over the next 10 years. So as we said, it really does come down to your subjective analysis, what you see the growth rate, but we've gone for 30%, which we see as a medium, in fact, lower than the last year, lower than the average growth as well. But as always, you can grab a copy of this model by clicking on the pinned comment below. For example, if you believe it should be much lower, for example, at 20%, it would be a much lower intrinsic value. If you believe it should be higher, around say 40%, as we can see, more than double the current trading price. But as we said, we're going to go with the medium rate of 30% into the final calculation, and we get an intrinsic value of $140. As always, we do use a margin of safety at 10%, and we execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe this with Nvidia, well, as you can see, you'd have to wait to around $126. So right now, it is trading between a 5 to 10% MOS. Again, there will be people who will say they'll wait for it to drop further. At 15%, you'd be looking around 119. At 20%, around 112. But as we said in today's episode, it is sitting at that 5% margin of safety. In terms of Wall Street and their forecast, well, they see the share price around $140, not dissimilar from our intrinsic value, with upside of 9%. As always, though, do let us know your thoughts in the comments below. Is Nvidia one you looking to buy today following the dip? Is it one that's on the watch list? Or maybe you're selling it because you believe we are seeing the all-time highs today. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts, and we'll see you all on the next one.